Peter Schiff, Chief Market Strategist of Europe Pacific Asset Management and the host of the Peter Schiff Show, is back with us to discuss all matters to do with the economy. Peter, welcome back to the show. Lots to discuss today. You've got a number of juicy tweets that our producer sent over, so I like to, your tweets are always a source of both information and entertainment, so we picked the ones that highlighted both areas, entertainment and information. But first, I want to play this clip from President Joe Biden. He made a remark on the economy. Take a listen.
Today, we received news that our economy had 0% inflation in the month of July. 0%. Here's what that means. While the price of some things went up last month, the price of other things went down by the same amount. The result, zero inflation last month. All
right, so Biden's remarks, a little bit confusing here. I think he was talking about the month-over-month numbers, but overall, I didn't realize we had 0% inflation. But let's just go over the numbers just to be clear. So headline CPI rose 8.5% year over year, month over month 0%. I think that's what President Biden was referring to. Core CPI rose 5.9% annually and only 0.3% month over month. So it seems like on a month-to-month basis, inflation has peaked. Do you agree?
Well, I don't agree at all. And first of all, what zero represents is Joe Biden's understanding of the U.S. economy, because he has no clue what's going on. You can't brag about the fact that we had one lone month where high prices didn't get any higher. It's not like they went down. They just didn't go up. But if people were struggling with high prices, their struggle didn't get any easier in the month of July. It remained the same. What would have been good is if prices could have come down, but they didn't come down. And in fact, the only reason that the headline number didn't go up was because we finally got some relief at the pump. Gas prices came down, but a lot of other prices, food prices keep going up, rents keep going up. In fact, you mentioned the core, yes, which doesn't include energy, was up 0.3 on the month. So if you annualize that, multiply it by 12, that's still a pretty decent sized number. Yes, it's not quite as huge as the numbers we've been getting, but there's always going to be an ebb and flow in these numbers. I mean, how many times last year did all these analysts, including people in the government, claim that we had peak inflation? I mean, I got sick and tired of hearing peak inflation back in 2021. I had to keep saying we're nowhere near the peak. And the same thing applies today. Yes, we may have hit a temporary peak. Maybe it'll take a few more months before we see a year-over-year increase that's higher than the 9.1 that we got in June. But there's no doubt in my mind that we will get a higher number than 9.1. We are nowhere near done with this inflation problem. It is going to be here for years and years and years, probably the remainder of this decade, and probably then some. And, so just looking at one-off month where, we didn't get a big rise and having this premature victory dance, I think is an insult to the American public.
Okay, let's come back on that. You think that inflation is not done rising? It's going to go above 9.1%. Peter, I just want to point out the fact that in no prior recession over the last 70 years has inflation risen during a recession. This time's going to be different?
Yes, well, as they keep telling us, this is a very unique recession. In fact, most people don't even want to admit that we have one.
Okay.
But, look at the recessions of the 1970s. You had rising prices there, during stagflation, and that's what my forecast is. Remember, last year, I was predicting the U.S. economy would be in recession in the first half of 2022, and very few people had that right. But I also predicted that inflation wasn't transitory, that it would get stronger as the economy got weaker, and that is exactly what happened. Now, the reason that I believe that inflation is going to kick into a higher gear as this recession that we are in gets worse is because I believe Powell is going to pivot ultimately, and he is going to give up his fight against inflation in order to fight a different foe, and that is going to be a recession and rising unemployment and potentially a financial crisis, either one that has already happened or one that is rapidly approaching. And so I think Powell is going to choose what he believes to be the lesser of the two evils. And I think he's going to pick fighting recession and propping up financial markets and monetizing government debt so the Treasury doesn't have to default. I think the Fed is going to pick that over inflation. And so unlike the pivot that we got with Volcker back in 1982, where Volcker pivoted after a victory in his fight against inflation, Powell is going to pivot despite defeat. Inflation is going to win. And so when we go back to 0% interest rates or whatever we do, and when we go to QE5, which is going to be launched, I don't think the Fed is going to shrink its balance sheet very much. It's going to shrink it less than it did last time it tried to do it, which is an impossible task given the bubble that it's inflated. I think when the Fed goes back to stimulus and creating inflation, when inflation is maybe double or triple or quadruple that 2% target, the markets are going to react very differently than how they reacted in the past. Because in the past, the Fed was able to justify all this cheap money because they said we don't have enough inflation. We're still below target. Well, when they go back to this stimulus, when inflation is triple or more their target, the markets aren't going to buy it. And so I think all the inflation that they are going to have to create in order to stimulate the economy out of this recession is going to ignite a powder keg. We already have an inflation problem, and Powell's going to pour all this gasoline on it. And so we're going to see inflation moving up to a much higher level, even though it's already very high. In fact, it's probably double what the government claims in the CPI. If you want to know what's actually happening to prices, you've got to double what the government tells you, and that's more accurate.
Okay, touching this pivot here, remember the Fed has two mandates, fighting inflation and maximizing the employment side. Now, unemployment has actually fallen yet again to 3.5%. You've actually tweeted about this. You said there was a net loss of full-time jobs in July, actually. All of the net 528,000 jobs added were part-time jobs, most of them low-paying service sector jobs. Now, I mentioned I read some of your juicy tweets. So I actually looked into this myself in the BLS, Peter. The recent jobs report came out. The number of persons employed part-time for economic reasons increased by 303,000 to 3.9 million. So of the 528,000 jobs added, 300,000 were part-time jobs. Now, the Fed's looking at the overall unemployment number, and they're probably thinking, okay, we don't have to fight unemployment right now because it's at an all-time low, right? Is that an accurate statement to make? Is that an accurate reading of the number?
Even if some of those other jobs were full-time jobs, and it's hard to say, but even if they were, they probably went to people who already had another full-time job. Because one thing that we know for this month or last month is that it's a new record. The number of people working two full-time jobs is now at an all-time record high. And why are people having to hold down two full-time jobs? Because one isn't enough. That is the problem. This labor market is so weak, workers are being forced to accept huge pay cuts, which is what they're doing. They're getting small increases in their wages, but it's being more than offset by enormous increase in the cost of goods. The cost of living is going up much more than their meager pay raises. And so what a lot of Americans are now forced to do is take another job. And many people that have one part-time job now have two or three because they can't pay the bills with a single job or even two jobs. So this doesn't happen in a strong labor market. In a strong labor market, workers get real wages, raises. They're able to get their boss to increase their pay by more than the increase in the cost of living. But in a weak labor market, workers are forced to work for lower wages, and that is, in fact, what is actually happening. And meanwhile, labor force participation last month fell to 62.1. That is the low for the year. And in fact, over the last 4 months, even though we've created all these jobs, the number of people in the workforce has gone down. And so that means that all the jobs that were created over the last 4 months were people who already had a job getting another job.
You don't think it's because people found renewed purpose after the pandemic? They just want to work more?
No, well, the data isn't lying. We have fewer people working than we had 4 months ago. You know, Biden claimed that we have a record number of people in the workforce. He was mistaken. He's wrong. We had more people working 4 months ago than we have working now.
Okay, well,
By the way,
yeah.
the record high for the number of people working is before the pandemic. So even though we've recovered the jobs that we lost prior to the pandemic, it's only because the same people have multiple jobs. We haven't recovered the workers. We still have a lot of workers that were working prior to the pandemic that haven't rejoined the labor force.
Okay, I want to come back to the financial crisis that you mentioned earlier in the interview, but first, another juicy tweet you made earlier in this in August last week. You said that there's no trade-off between inflation and economic growth. Real economic growth increases supply, holding prices down. The problem is that our economy hasn't had real growth thanks to the Fed. It experienced an artificial bubble. To fight inflation, that bubble must be popped. Just going back to the first part of your tweet, Peter, there's no trade-off between inflation and economic growth. The Fed's talking about a soft landing, which is a trade-off between economic growth and inflation. That's not possible?
Well, first of all, we can't have a soft landing because a soft landing means we avoid recession. So by that definition, we've already crashed, or it's a hard landing. But there's no way we can have a soft landing.
We don't know for sure if it's a recession. The definition has been muddled.
Well, I don't care how the politicians want to redefine it. It is what it is. And so, okay. I'm not going to change the meaning of a word just to deny that we're not in something that we're in. But the point of that tweet is you have all these Keynesians that somehow believe that inflation is caused by economic growth. They also think it's caused by too many people working. They think there's a trade-off between unemployment and inflation. They think if there's not enough people unemployed, you're going to have more inflation. And the way to get rid of inflation is to put people out of work. All of this is Keynesian nonsense. Inflation is not caused by the private sector. It's not caused by growth. It's not caused by people working. The only people working that cause inflation are the people at the Fed who are running the printing presses or pushing all the buttons that are creating all the money. That's where inflation comes from. And they create inflation in order to monetize U.S. government debt. So the federal government runs a big budget deficit. The Federal Reserve prints up money to buy those bonds, and that inflation enters the economy. It's got nothing to do with growth or people working. As a matter of fact, in a real economy, the stronger the growth, the lower prices. Because what is economic growth? It means increased output. It means more goods and services are being produced. Well, if you increase the supply of something, then you decrease the price. So a productive economy that's producing more stuff means that the price of that stuff is lower. The same thing with people working. If more people are employed productively, their productive output is increasing the supply of goods and services, keeping the prices down. If you slow down real economic growth, if you force people out of work, you're going to have less supply. We're not going to make as much stuff. We're not going to be offering as many services. And so therefore, the prices of those goods and services, all else being equal, are going to go up.
Peter, you're right. When the economy is doing well, more people are working and there's more supply, there's more output. But you got to remember also when this happens, when the economy is doing well, there might be also more aggregate demand, which could also push prices up, right? It's a counterbalance force, is it not?
Well, wrong.
No?
You remember that supply creates demand. So if people are producing and putting goods and services into the economy, well, now they have the ability to share in that production. They've earned money helping to create stuff, and now they could spend that money to buy the stuff that they created. And so the demand that comes from real production doesn't cause prices to go up. The only kind of demand that causes prices to go up is when the government just prints money and gives it to people. And so that money is not a function of production. People didn't earn that money producing. They just were sent the money by the government. I mean, that's what happened during COVID to a huge degree. You had people who had jobs and were working to help make stuff. They went home. They weren't working at all. They weren't making anything. But now the government sent them money. They weren't earning money because they worked. They were being paid not to work. But the worst part about it was many people were paid 2 or 3 times not to work than what they earned when they were working. So now these people who weren't working at all had all this money to go and buy stuff, but they didn't help produce any stuff. That's what pushed up prices, because you had all this fake demand and no supply. You see, The proper monetary policy response to the pandemic, if everybody was going to stop working, the Fed should have shrunk the money supply, not expanded it. The U.S. government should have cut spending, not spent more. That would have balanced out supply and demand. But instead, we had the worst combination of monetary and fiscal policy probably in the history of the country. In the face of collapsing supply, we flooded the economy with phony demand. And so we're experiencing now, I think, just the beginning of those consequences. We've got a long way to go, which is why the idea that inflation has peaked is nonsense.
One way that the government plans to fight inflation is with this new Inflation Reduction Act. Hasn't been passed yet, but the legislation is supposed to authorize $430 billion of spending, $300 billion of which is earmarked for fighting climate change. Another proposition they're making is a 15% minimum corporate tax. Is this going to help, Peter?
Of course not. It's going to hurt. Historically, whenever they brand a piece of legislation, whatever the name is, the effect will be the opposite of that name. So if a bill is called the Inflation Reduction Act, then right off the bat, the effect of the bill is going to be to increase inflation. And that's exactly what it's going to do. First of all, there's all this new government spending. That's more demand, artificial demand, coming into the economy. How is the government going to get all this money that it's going to spend? Because it's not going to get it from those tax hikes. It's ultimately going to get it from the Fed. The Fed is going to have to print more money to monetize those debts. Now, even if the Fed doesn't do that, and the government has to find private buyers for those bonds, well, then the government, or rather the Treasury, has to find private buyers for those bonds. It's going to crowd out investment in the private sector. And so that's going to mean fewer things are going to be produced because the private sector is going to have less money to invest in capital and things to improve productivity. And so that ultimately causes prices to be higher. So will the increase in corporate taxes, because to the extent that corporations have to pay higher taxes, it comes at the expense of lower investment. So if corporations have less money to invest in plant and equipment and expanding supply, that ultimately puts upward pressure on prices. What the government needs to do to reduce inflation is reduce government spending. We need a bill that cuts government spending. The government is doing the opposite. They are increasing government spending. So what they're doing is they are throwing gasoline on a fire that's already burning hot.
One thing that the bill aims to accomplish is allowing Medicare to negotiate prices with the pharma companies directly for certain prescription drugs. The idea is that for certain demographics, like seniors, for example, their medical bills could, in theory, go down. Now, medical bills in the U.S. are a rising component of disposable income. Potentially, this might help some people in fighting inflation domestically in their homes, I guess.
Well, why don't they just pass that then? Why do they need all the government spending that will increase inflation to offset that? Look, I'd like to get rid of Medicare and Medicaid and Obamacare. I mean, all these things are driving up the cost of health care, and we should get rid of the FDA, which is dramatically driving up the cost of prescription drugs. The government makes everything more expensive. It's the free market that makes things less expensive. So if we want to help put downward pressure on prices, we got to get government out and let the free market in.
Speaking of the free markets, well, the free markets seem to be kind of ignoring bad economic data. Well, maybe they are factoring in good economic data. Who knows? But the point is, Peter, for the last month, for a full good month, the S&P 500 and other stock market indices in the U.S. have been on a tear. Just today, just on Wednesday, the S&P is up 1.8% as we're speaking right now in the afternoon, in the middle of the day, close to market close. Now, you were talking about a financial crisis earlier in the interview. I want to talk about this financial crisis. It doesn't seem like the markets are anticipating a crisis anytime soon, or maybe they're just ignoring, maybe investors are just ignoring some of the signs, Peter.
Well, that's because they still remain hopeful that the Fed's going to be cutting interest rates by next year. Now, in fact, they may be cutting interest rates before the end of this year, but it's not going to be because they've won a victory over inflation. It's going to be because the economy is in a much more severe recession than the one it's in right now. In other words, this recession that's here is going to get worse, and that's going to force politicians to try to do something. You know, once the political pressure is greater because of unemployment and the economy, then the Fed is going to switch its attention from inflation. But the inflation problem is not going to go away. It's just that this other problem is going to loom larger in the eyes of the Fed. And I think what's driving the markets is this bad news on the economy is good news for the markets because it means the Fed will pivot sooner. And before it pivots, it will raise rates less than it might have raised, absent the bad economic news. And again, you still have all of these Keynesians out there that think bad economic news is good news on inflation. They think the weak economy will weaken inflation. It won't. It is going to strengthen inflation, especially when the Federal Reserve and the government respond to the weakening economy with more stimulus, because that stimulus is inflation. So they're going to start creating more inflation, even though we already have too much inflation. And so the problem is going to get much bigger than the markets understand.
How long do you think this rally is going to last then, Peter?
Well, I don't know. I mean, you know, I still think this is an overall bear market. I think that rate hikes are going to continue to take their toll, but so will inflation. I think inflation is going to harm a lot of companies that have a problem dealing with it. I think a lot of demand is going to be destroyed for a lot of discretionary items because people are going to spend all their money on food, on energy, on insurance, on rent, on taxes, you know, especially if we get another, 80,000 IRS agents that are going to be harassing the middle class, a lot of small business owners and the people who are self-employed. They're going to be spending a lot of energy dealing with the IRS that they won't be able to spend working. And then the IRS is probably going to shake them down for some additional taxes, interest, penalties. So people are going to be dealing with that. And that's going to be another problem for companies trying to sell American consumers products when they're broke.
I had this discussion with a friend the other day. We're talking about layoffs, particularly in tech sector, Netflix, for example, Coinbase, companies in the crypto sector. And he was saying that, well, this is not indicative of the entire economy. These companies were just poorly managed companies that overhired during the pandemic. Do you agree with that sentiment?
Well, I agree that these companies probably way overhired, but they're not the only ones. Sure. There are a lot of companies that are losing money. I think last year we set a record for IPOs of companies that lose money. And so all of these companies, zombie companies, are creatures of the bubble that was inflated by the Fed with inflation, artificially low interest rates, zero interest rates, and quantitative easing. That's what gave birth to all of these zombie companies. And now that the Fed is raising rates and is no longer doing quantitative easing, all these zombie companies are going to die. And it's a lot more than just Coinbase and Netflix. And, you know, I don't think Netflix is going to go away. I mean, I think Netflix is a viable business, but investors have way overpaid. It's very competitive now. There's so many streaming services out there, and the public can't afford them. I mean, they don't have enough money for all this content. And so there's a lot of competition. It's very easy for people to subscribe to one of these services for a week, you know, binge watch whatever they want to see, then cancel their subscription. It's very easy to just use a family member subscription, a friend's subscription. So people are going to find a way, you know, to circumvent a lot of this. But, you know, companies like Coinbase, I mean, that's all part of the crypto bubble. I think most of the blockchain crypto related companies are going to go out of business. I don't think they have viable business models. I don't think most of these cryptocurrencies are viable. In fact, I don't think any of them are. I think all of them, including Bitcoin and Ether, are ultimately going to zero. It may take a while before they, you know, flatline completely. There'll always be some fools willing to buy thinking they're going to get a bargain. But I don't know how long a lot of these companies will be able to stay in business and keep writing paychecks when they no longer have access to capital because they don't have any earnings to fund their operations. They rely on selling stock to investors who just believe that they can buy the stock and the price will go up. But when that, you know, fantasy meets reality, these companies are not going to be able to access any capital. And so they're going to have to slash their workforce, and many of them will end up just going out of business completely.
All right. If you want to go there, let's go there. We're going to talk about cryptos towards the end of the interview. One more question about the financial markets, and we'll move on to that, Peter. I know you love bashing cryptos. And okay, financial markets, financial crisis. What should investors do then right now to prepare for this financial crisis? Is now a good time to be picking stocks? Should you go bottom up, Peter, or should you wait in the sidelines, or should you just stick to an index fund, maybe buy gold? What should people do?
Well, I think the nature of this financial crisis is going to be a lot different than the one we had in 2008, because I don't think the Fed is going to allow it. That's one of the reasons I believe that Powell is going to pivot, because if the Fed does keep raising rates, we will have a financial crisis that looks like 2008, only much worse. Because 2008 was about bad debt. It was about people borrowed money and they couldn't pay it back. And the collateral for the loans was no good because it was real estate and prices went down. Well, we have much more debt now than we had in 2008. I mean, by an order of magnitude. Everybody has more debt than they had back then. And so this is going to be a much bigger crisis when the defaults start. And all those banks that were too big to fail, that were bailed out in 2008, they're a lot bigger now. And when they fail, it's going to be a lot worse, except with inflation too high and the Fed fighting inflation, there are no bailouts. There's no TARP 2.0. All these banks are going to have to be allowed to fail. And that means customers are going to lose money, not just stockholders or bondholders. The customers are going to lose money because the FDIC doesn't have any money unless it gets it from the Fed. And the Fed isn't going to be giving out money if it's fighting inflation. It's taking away money. So I believe the Fed is going to pivot to prevent that massive financial crisis. And so what we're going to get is a sovereign debt crisis and a US dollar crisis. So it's going to take the form of a crashing dollar. And so the people who are going to lose money are not the people that are just holding subprime mortgages, but the people who are holding US Treasury bonds or any bonds denominated in US dollars, or even people that have US dollars stuffed under their mattress. You know, the dollar has risen so far in the early stages of this big inflation because investors are still delusional about the Fed's ability to contain inflation and bring it back down to 2%. When they wake up to reality that inflation is going to be way above 2% indefinitely, then the dollar is going to fall through the floor, and then things like gold and silver will go through the roof.
Okay, let's talk about that briefly. I don't think, to my knowledge, Peter, correct me if I'm wrong, but to my knowledge, I don't think the U.S. in its history, in modern history, has ever experienced a dollar sovereign debt crisis to the point where default might be on the horizon. Is that what you're describing is going to change every single finance textbook that defines treasuries as AAA, AA, depending on whatever, rating agency you're talking to?
Well, not quite, David, because remember, in 1971, the U.S. defaulted on its obligations because Nixon took us off the gold standard. But prior to that, if you owned a Federal Reserve note and you were a foreign central bank, you owned an obligation of the United States government to pay you gold. Federal Reserve notes were notes for gold. And the US government defaulted on those notes. We told all of our international creditors, we promised to pay you gold. If you had $35, we promised you an ounce of gold. And they did a couple of devaluations first, but that wasn't enough. And then Nixon said, you know what? We're going to default completely. We're going to give you no gold for your notes. We're going to pay nothing. So that was an official default. And then gold went from $35 an ounce up to $850. So people who had U.S. Federal Reserve notes, thought they were going to get a certain amount of gold. They ended up getting a fraction of that gold because the value of the dollar imploded relative to gold because we defaulted on that promise. But we didn't officially default on treasuries, but we defaulted on the fact that those treasuries were supposed to be repaid in gold. Because when we repaid treasuries in Federal Reserve notes, that was the equivalent of gold. They used to say the dollar is as good as gold because it was not only backed by gold, but redeemable on demand for gold. So that was the first default. This default is going to be different because obviously we're no longer on a gold standard. So nobody who owns US treasuries or US dollars has any expectation that they're going to be given gold. But they do believe they're going to be able to afford to buy gold. They're going to wake up to the reality that gold's going to be so expensive in terms of dollars, they're not going to be able to afford to buy any, because I think the dollar is going to implode, and I think it's going to lose its status as the reserve currency, and that is going to be a game changer for the U.S. economy because we rely on the ability to exchange the paper we print, U.S. Federal Reserve notes, dollars, for the goods the rest of the world produces. So we are dependent on the rest of the world for the goods that we consume. And we don't have to produce goods in exchange. And that's been the free ride that we've had on this global gravy train. And that's going to come to an end. And that's going to have profound implications for the U.S. economy and the standard of living of America.